Hello everyone, good afternoon. It's a pleasure to be here in the beautiful city of Istanbul. And today I'll be speaking to you about bridging the gap between TradFi and DeFi, which first requires us to fully understand what is traditional banking and some of the problems that it has. Now bear with me, I know I've only got 15 minutes for that. I'm the founder of Valhalla Network, and we're creating a decentralized banking system of community banks. So today, there's a serious misunderstanding of the role banks play in society. They're still thought of as financial intermediaries, moving money from one person's account to another, which is understandable. It's what's being taught in mainstream economics. It's what I was taught when I joined HSBC. They teach you that banks are just financial intermediaries. They're not really important on the wider system. They just move money from one person's account. It's all a lie. In fact, banks are much more like wizards. They create money out of thin air. Every time a bank issues a loan, newly created money is issued. Now this has a massive impact on your everyday life, and it decides which industries do well versus which ones go bust. So if banks are the lifeblood of the economy, small businesses are the backbone. They account for roughly 90% of all jobs in the UK, for example. However, evidence shows that they've really struggled to access any funding from the capital market, meaning they rely heavily on bank funding, except banks are not lending to them. Over time, the banking system is becoming more concentrated as well, as the big banks buy up the small banks. And in Europe alone, under the ECB fantastic policies, the number of banks has reduced by almost 50%, meaning you've got these larger banks that are not interested in small businesses. They're interested in lending big amounts to big businesses. This ultimately means that you have recurring boom-bust cycles, where you get these areas of high growth and high bubbles and everything, and then suddenly you get boom and bust cycles coming in, everyone goes into recession, you get high unemployment, you get bankruptcies, and you get inequality. The red line here shows what a system such as ours, Valhalla Network, will be able to produce for an economy. So how does bank credit creation actually happen? Well, every time a loan is issued, a bank isn't actually moving money from one person's account and issuing it to a borrower. In fact, a bank is actually purchasing a loan contract from the borrower. They are purchasing a promissory note. Now, when you purchase a promissory note, you now have a liability on your balance sheet. You owe money to that person. So you've got the asset, the promissory note, and you've got the liability, the money you owe. So then what banks do is they say, okay, well, that liability, let's just rename that. And what do we call it? Let's call it a deposit. Let's say, well, we've deposited the credit in your account, when in fact they haven't deposited the credit in your account at all. But by doing that, they can expand their balance sheet, meaning credit is being created, and over 95% of the total money supply is created by the banking system. It is not created by the central bank. Oops. So how that happens and the impact it has on you depends on what they use it for. So bank credit creation can be split into two streams. You've got credit that is being created for the real economy, for GDP-related transactions. And you've got credit that is being used for financial transactions, such as real estate transactions that is not part of GDP. Now, credit, loans that are issued for the real economy, you've got two cases of that. You've got consumptive credit, which has been like 2020 to 2022. We had loads of consumer credit being generated by the banks. What you do is you get economic growth, fantastic, but it's all the result of inflation. It's unproductive credit because they issue the loans, but you're borrowing, but you can't repay it because you're not using that money to generate any new income stream. So you just get a load of inflation. So that's no good. Case 3, when you have non-GDP credit and you get this financial credit being created. So if I'm going to a bank saying I want money to buy loads of real estate, let's say you're a big PE firm, and banks love that because then you can take a massive amount of loan to them. What happens? You get these asset price speculation. You get these big bubbles in the asset market, and then suddenly when the banks stop lending and the tap's turned off, you get a collapse and you get recessions, etc. So what you want is case 1, which is productive credit creation, which is when you're lending to businesses such as small businesses that are using this money to create new income streams. Maybe they're using it to buy a new piece of machinery or perhaps hire more staff so that they can generate more money. Either way, they can repay the loan, which means you then get credit destruction, meaning you get that economic growth, but without any inflation. And that is what we want. That's the perfect sweet spot. Now, what's decentralized finance? Well, as you know, it's about using emerging technologies and applying it to existing industries, such as the existing financial system. It offers advantages such as increased access to information, making it easier for borrowers and lenders, but easier for people to access funding that they need, such as Aave, who issue loans and borrowing and savings and all that with Aave. However, people who think that these DeFi solutions can replace the banking system do not understand the role banks play. As you can see, banks are just more than financial intermediaries. You can't replace them. You can't say all these DeFi solutions that do not create money can replace a function that creates money. It's impossible. So therefore, what we should be doing is something that I like to call true decentralized finance, which is when we take emerging technologies, such as blockchain technologies and smart contracts, and we apply it to the existing banking system to make the existing banking system better and more decentralized. So how do we do this, and what's the solution to everything? Well, we need to focus on small and medium-sized businesses. That's the key part. They're the ones who are generating most of that productive credit creation. They're the ones who are using that productive credit creation, So they're leading to economic growth without inflation. Now, a recent study done by Professor Richard Werner, who happens to be our chairman, shows that over time, as these banks are getting bigger and bigger and bigger, they're less prone to focus on small businesses. They're much more likely to lend to those large businesses. As I've said, they've got a growth target. It's much easier to hit that target if you're lending a large amount to one big borrower than it is to lend loads of small amounts to loads of small firms. So it's completely understandable. But if this is happening and big banks aren't interested in small businesses, and you can see that the number of banks is reducing, suddenly small businesses have no access to credit. They can't borrow. They can't access their banks. A recent survey we did in the UK found that over 60% of small businesses don't even ask their bank for a loan because of the fear of being rejected. They're being pushed into digital solutions that a lot of them don't want. They don't know, they don't really want to use their devices, they don't know how to use them maybe, and they don't want to be forced into that route. Automated responses and stuff like that. They're not getting traditional face-to-face banking. They can't even get in the front door of the banks because they're not interested in speaking to them. Whereas you need small banks, bless you, you need small banks that focus on those small businesses, that are there only to focus on small businesses. They don't care about the big businesses because they're banked by the big banks. So we need to decentralize the banking system. We need to set up many small local banks, thousands of these banks. We need to set up thousands of banks that only lend to small businesses in their local area. Each of these banks can be partly owned by a charity foundation as well for that local area, so it can reinvest a portion of the profit that the banks make back into the local community through sport development programs, education, any social initiative that the local community needs. Ultimately, this democratizes finance, and it allows people to access these attractive central bank credit lines. Now, one way we're doing this through Valhalla Network is there's this three parts to our framework. You've got the DAO Foundation, Decentralized Autonomous Organization, which has distributed governance mechanism to allow token holders to govern the system, to allow token holders to govern the banking system that we are creating. We then, in phase 1, set up a for-profit bank. It's a specialized banking model that Professor Richard Werner, myself, and a few others have devised and improved over years. And the purpose of this bank is to propel us into phase 2 by being quickly profit-generating. And then in phase 2, I might need a drink soon, my mouth's going dry. In phase 2, we set up the community banks. We set up all these little banks in whichever countries, whichever locations that the governance token holders are voting for. They're the ones controlling the system. They're the ones governing it and deciding how much money we're raising, what it's used for, how much money is being reinvested into the system. How many of these banks we want to start up every year is up to the token holders. So over time, this network will grow. And these community banks, after about 5 years, each community bank will have helped over 2,000 small businesses. And in 10 years, each community bank would have generated 5,000 new jobs. Now, is that productive? Of course it is. So we need these community banks in order to get that real nice economic growth without inflation. So what's the inspiration to all of this? Well, Germany has done a fantastic job with community banking. There's over 1,500 community banks in Germany. The Sparkasse. I don't know if I pronounced that right. Forgive me if I didn't. These community banks in Germany, they're the ones who are lending only to those small businesses in their local area. So they have really made the business model and the banking model, they've really expertised it and made sure that when we take it on and we improve it, we've got the best that's out there. Professor Richard Werner, Valhalla Network's chairman, he was my university professor actually, it's how I met him. And I've been working with him many years. And he's been pioneering community banking for the last 20 years, trying to push it and trying to promote it and educate people on why community banking is so important. And I'm a director of local first community interest company in the UK with him. Now, Professor Richard Werner, he's the inventor of quantitative easing, the central bank policy tool you must have heard in the news over the last 10 years. It's been talked about all the time. The truth is, he invented that policy tool to get the Bank of Japan out of the Japanese recession. In the 80s and the 90s in Japan, there was a big bubble, asset bubble. Why? Because there's loads of financial credit being produced. These banks were lending to real estate buyers, to speculators, where the land around the Emperor's Palace in Japan was worth more than the entire state of California. That's how big this bubble was. And then the Bank of Japan, in all their wise self, they said, stop lending, turn it off, just turn it off. No more loans. Well, suddenly, all that land is not worth the money that people were buying. So suddenly, they can't repay their loans. It's non-performing debt, which means these banks then have a load of non-performing debt on their balance sheet. Their books are pretty much screwed. Their equity doesn't look good. Suddenly, they're in trouble. What happens? Well, you can do quantitative easing, where the Bank of Japan can step in, create money, buy this bad debt off the bank's balance sheets. So he devised this policy tool and promoted it to Bank of Japan and said, you can get out of Japan out of recession easily, without any taxpayer money. Do this, and I'm calling it quantitative easing. Central banks have since taken his policy tool and effectively abused it for the last 20 years. They've sort of said that we're using quantitative easing, but not what it was meant for. It's only meant to get an economy out of recession following a boom-bust cycle due to too much financial credit creation. If the right conditions exist, communities all over the world can thrive, including those developing countries that desperately need this. Together, all of us can create these conditions. Like I said, I'm Oliver Studd. Thank you very much for your time today. I look forward to speaking to you all shortly. Cheers.